Hello, everyone, and welcome to Money Matters with Doug Jones, the personal finance show focused on moving you forward financially. I'm Doug Jones, and today I thought we would talk about home equity lines of credit, or Helocs as they're known. And the reason I thought we'd talk about them is they've become a preferred method of borrowing for Canadians. In fact, over the last 15 years, they're said to have contributed more to our household indebtedness, except for mortgages. And to discuss Helocs, we're joined today by Charles Gibney, who is a Senior Research and Policy Officer at the Financial Consumer Agency of Canada. So Charles, welcome to the show.
Thank you. Thank you for having me.
So I thought what we would do today is start by explaining what Financial Consumer Agency of Canada, or FACA, does in your policy, because a lot of viewers may not know who you are.
Sure. Thank you. So the FCAC, or the Financial Consumer Agency of Canada, is an independent agency of the federal government, and our mandate is to protect financial consumers. So we do that principally in three ways. First, we supervise federally regulated entities. This is mainly banks, to ensure that they are in compliance with federal consumer protection law, which includes regulations, guidelines, and voluntary codes and commitments. The second thing we do is we work to educate financial consumers and strengthen financial literacy through a variety of programs. And finally, we engage in research. So we are charged with studying the marketplace, looking for trends, identifying emerging issues that have the potential to impact financial consumers, such as Helocs and Heloc trends.
All right. So let's start with the basics. We're here to talk about Helocs. So can you explain what a Heloc is? How's it different than a mortgage or an equity loan? Because I don't think people fully understand that there is a difference between the three.
Sure. So a Heloc can be complicated, and there are many features that a consumer can customize with their bank or their lender. But essentially, a Heloc is a revolving credit product that's secured by a lien against the borrower's property or residence. So it's a line of credit in which the consumer's home equity serves as collateral for that credit line. And so by revolving, what it means is it's open and it's non-amortized, and essentially the consumer can borrow and repay at their convenience, provided they stay underneath their credit limit and they make their minimum payments every month. So it's similar to a credit card or a line of credit in terms of the convenience of borrowing. And because it's open and non-amortized, the consumer does not have to make principal payments. They don't have to repay the principal. They can just make interest-only payments each month, and there's no prepayment penalty for making large lump sum payments against the principal if they're able to do so. It's not amortized and it's open, which also means the consumer does not have to reapply or renew it on a fixed schedule. Most consumers tend to leave their Heloc open until they sell the residence that's securing the credit line. I think it's also important to point out that Helocs have a variable interest rate. So that interest rate is based on the lender's prime rate and then a premium of 0.5% or 2% above that prime rate. And it's variable, which means both of those rates can change at the lender's discretion. You have to notify the borrower that they can increase or decrease their prime rate, as well as the premium that the consumer pays above or below that prime rate. I think that one of the things that we found in our research that's important to point out is, most Helocs today are sold under a larger umbrella product called a readvanceable mortgage or a hybrid mortgage. Most consumers will know these products by their brand name. So a TD Flex Line or a Manulife One or a Scotiabank Step. And what this does is it combines a Heloc with a traditional mortgage. And as the consumer pays down their traditional mortgage, the principal on their house, they get more available credit in their Heloc. So over time, a readvanceable mortgage rebalances and the Heloc gets bigger and the traditional mortgage gets smaller.
So I think there's an important point there that I want to make sure that people understand is that with a mortgage, you have a amortization period, meaning you have a defined period for the loan, which requires principal and interest payments, so that once you enter into it, if you do a 25-year amortization, in 25 years of your payments, your mortgage is discharged.
That's right.
But with no amortization period on the HELOC, if you're making those minimum interest-only payments, in 25 years, you still have the same principal outstanding balance. And I want to make sure we differentiate that for people.
That's correct. And that is the essence of a HELOC and the difference between it and a traditional mortgage. It gives the consumer that flexibility to make as large a payment against the principal as they're able to do when they're able to do it. But there's no obligation to make a payment against that principal.
Okay, so if a person's interested, what are some of the criteria that financial institutions are looking for to advance you a HELOC?
Sure. So lenders are going to look at the standard criteria of credit worthiness. They're going to look at a borrower's credit history, their credit score. They're also going to look for proof of stable employment and sufficient income. And finally, they're going to assess the borrower's debt ratios. So essentially, a ratio of the cost of carrying the debts that the consumer has to their take-home pay each month. Now, because a HELOC is a variable interest rate product, most lenders are going to subject the borrower to what they call a stress test. So they'll increase the interest rate several percentage points above where it is, and they'll make sure that the borrower's income and debt ratios are still sufficient and appropriate. And then, of course, the last thing is the house is serving as collateral. So the HELOC that's extended to the consumer cannot exceed 65% of the value of the consumer's home. So depending on how long ago the consumer bought the house, they may need to have an appraisal done to establish the current market value of that home.
Right. And when you do the re-advanceable, aren't they able to go up to 80% because there's a mortgage and a HELOC component combined?
That's right. So in a re-advanceable umbrella mortgage product, they can have the two combined, the traditional mortgage and the HELOC can come up to 80% of the value of the home.
So I think one of the things I want the viewers to understand is how important HELOCs have become in sort of the Canadian economy. So I was reading a report that said in November of 2020, there was $272 billion in HELOCs out there. Mm-hmm. And then I was reading another one that said the average was just under $100,000 with 57% utilization. So this has become an extremely significant component for Canadians to borrow against. I also saw that between 2011 and I think it was 17, the use of HELOCs and mortgages had increased 40%. And I suspect during this last year, it's even got higher. So why is it that you think people are jumping on these HELOCs and using them so much?
Sure, that's a good question. We studied it in 2017, and what we found was that there seemed to be three principal drivers of the increase in HELOC borrowing, and it's prevailing low interest rates. We've been in a period in which interest rates have been quite low. So for a variable interest rate product, that can make HELOCs look more attractive to consumers, to borrowers. The other thing to keep in mind is we've been through a period of sustained increases in house prices. So many consumers have more equity against which they can borrow. And then the third thing is really the sales practices of banks and other lenders and the way that they've positioned this product. So as we've gone through this period, especially since 2000 and through the 2000s of increasing house prices, lenders have really positioned the HELOC as almost the default product for consumers who have a 20% down payment or at least 20% equity in their home. And I think that has been an important factor in recent years.
So as it's becoming ever increasing, it's a form of borrowing, as we've noted, and there's pros and cons to any form of borrowing. Mm-hmm. So what I thought we should do is summarize what are some of the pros, and then what are some of the cons to having a HELOC. So let's go with the pros, because there are some real good positives to them.
Yeah, I think there are some pros. It wouldn't be as popular as it is if there weren't some advantages to borrowing on a HELOC. And I think the first one is the one that we've touched on a couple of times, which it's affordable. It's a low interest rate. Because the house is serving as collateral, banks are comfortable, lenders are comfortable lending it to consumers at a relatively low rate. So that makes it useful for big ticket purchases, right? Home renovations, buying a cottage. You can get a lower interest rate than you would have otherwise, again, because you're using your home as collateral for that loan. I think it can be very convenient for consumers. They don't need to reapply. So if you have an ongoing project with ongoing costs, like a home renovation, it can be very convenient to draw down on the Heloc without having to go to the bank and explain why you need more money. And finally, the flexible repayment terms, being able to repay as much or as little as you can afford, especially for borrowers who are paid irregularly, who receive commissions or have a bonus-based salary. I think the ability to be flexible in your repayment schedule can be a real advantage.
And so that's the positive, that it's open, you can structure your payments to match it, but there are some cons to it. So do you want to go through some of the negatives or things to be concerned about?
Sure. I think that, and you've seen some of this probably in the media, I think my main concern with Helocs is that without a plan and without a fair amount of discipline, consumers can use a Heloc to get in over their heads. So over time, you can take more vacations than you would otherwise, do a more expensive home renovation than you might otherwise if this credit wasn't available. And you can slowly find that you've borrowed a lot more than you can repay comfortably without making a large number of sacrifices. I think this is what people are talking about when they say people are using their home as an ATM. It's essentially using the Heloc to live beyond your means rather than using the Heloc for a defined purpose or project. I think that's one of the key risks. The other would probably be the lack of obligation to pay down the principal. So that can lead Heloc debt to persist for long periods of time. And the longer it persists, the greater the chances that your circumstances could change for better or for worse from when you first undertook the debt. So an example of that could be the debt persisting into a period in which you're trying to transition into retirement.
Okay. And then I think there's also some of the additional ones of if interest rates were to increase, it's variable. So you'd be caught with the higher payments. But we're going to go to break. And so we've had a good discussion on sort of what Heloc is so people understand it, some of the pros and cons to them. But I think there's some other concerns, and I'd like to cover those when we return from break. Hello, everyone, and welcome back to Money Matters with Doug Jones. So before the break, we were talking about Helocs, and we were joined by Charles Gibney from the Financial Consumer Agency of Canada. And we were going over sort of how you apply for a Heloc, what exactly Heloc is, and sort of some of the pros and cons to them. But I believe that, as was noted in the first segment, the Financial Consumer Agency of Canada has been doing some studies on Helocs, and I think that they have raised some additional concerns. So Charles, could you go through some of those additional concerns that you're noticing to educate our viewers?
Sure, thank you. So I think that what we found when we did our initial research in 2017 and 2018 is we found that it seemed most consumers didn't fully understand what they were getting into. In particular, they didn't understand some of the risks or downsides associated with Helocs, such as the variable rate interest and the potential for their cost of borrowing to rise over time. And so we conducted a survey and we tested consumers about their objective knowledge of the terms and conditions of Helocs. And we found that most consumers scored less than 50% when tested on their knowledge about the features, the terms and conditions of Helocs. And that is concerning for us because the product is much more widely sold and widely held than it used to be. And it suggests that consumers don't necessarily know what they're getting into, which means that they are more vulnerable to some of the pitfalls and risks that we've been discussing, such as debt persistence, and overborrowing or getting in over your head with your Heloc.
Okay, and so I was looking at some of the questions that you had asked in that survey. And what I was surprised with was that your overall result for people with a HELOC was only 4 out of the 9 questions. But it was questions like, did you know that your interest rate was variable and could be increased? Did you realize there wasn't an amortization period on the loan? The banks actually can reduce your borrowing capacity or demand. And I was surprised that people who are entering into that level of commitment as it's a loan against their house were unaware of it. I'm assuming you were equally as surprised by those studies.
Yes, we were surprised, and in particular that consumers who have a HELOC didn't score at least 50%. They did tend to score twice as well as consumers who didn't hold a HELOC, but those results were definitely concerning and show that there's more work to do for sure.
Yeah. What I've noticed is in my sort of work life, I meet people with financial difficulties, and I'm surprised at how many people tell me about their amount of debt they have, and it's almost an afterthought. And oh yes, I have that loan against my house. They don't call it a HELOC, but it's a secured loan on their house, so I know what it is. And they just sort of forget it, that it's $50,000 or $60,000, but because they're making the minimum interest-only payments, it doesn't even sort of come into the equation of their debt, which I think leads to your conclusion that most people don't actually pay off the HELOC until the house is sold. So I think that is an indication of that persistence of debt. So how concerning were these statistics to the Financial Consumer Agency of Canada, and what are some of the things you'd like to see put in place to help educate the consumer?
Sure. So they were concerning. We think that over the course of the last 10 years, the market has more or less matured, and while the overall figure of how much consumers have borrowed against their HELOC has continued to increase, the growth has not been as dramatic over the past 10 years. Most people who are looking for a HELOC would qualify for a HELOC. They have a HELOC at this point. There were important regulations put in place by the government following the financial crisis. The HELOCs did play a role in the financial crisis in the United States. And so in Canada, the leverage limit was reduced from 80% of the value of consumers' home to 65%. And HELOCs are no longer eligible for that portfolio insurance that banks need to buy to use the securitization channel. So those changes appear to have slowed the growth of HELOCs significantly in Canada. And what we're focused on now is increasing consumers' awareness of the risks, but also how to use a HELOC to their advantage if they decide that it's an appropriate product. How to educate consumers about some of the features you've been talking about, like the demand function of a HELOC, the ability of a lender to call in that loan if they think that the material circumstances of the borrower has changed. And consumers need to understand that and be prepared for that rare but possible eventuality.
And to educate them, is it the financial institutions? You're looking for increased regulations from the financial institutions to educate them? Or is Financial Consumer Agency of Canada, like, I'm familiar with your website, I'm familiar with all the various resources that are available there, but I'm not sure most people are.
Sure. Well, I think all three stakeholders have a role to play. So FCAC, we do what we can. We promote our material through our social media channels. We've put a wealth of material online, as you've seen, since conducting our research. We also make ourselves available for interviews such as this one, and we conduct regular and periodic research on important issues like HELOCs and then publicize the results. Consumers have a role to play as well. When they're taking on a large and significant debt like this, it's important for them to do some research, to look into the material that's available online, to read the terms and conditions that are provided by banks, and to ask questions if there's elements that they don't understand. Banks, in turn, have a legal obligation to explain the Heloc, the terms and conditions, all of the features of the product in language that is clear, simple, and not misleading. And this goes well beyond simply providing the government mandated disclosure. Banks are expected to walk consumers through the features of a Heloc, how to use it effectively, and the risks associated with it. And we were very clear with banks after our research that we expected them to do more, particularly around explaining the disclosure. The survey results suggest that there's still work to do. I think in fairness, Helocs are complex, as we've been discussing, and they are new in comparison to car loans and mortgages. And so perhaps this is a little bit of growing pains associated with introducing a new product or relatively new product into the marketplace.
So over the last year, what we've seen, of course, is a very, very rapid rise in home values. I talk to financial institutions and mortgage brokers all the time. And what I understand is that during the last year, they have been extremely busy in rewriting mortgages and obviously advancing Helocs. We see that in the construction trade, home renovations are at all-time highs because home prices have gone so high, people are doing more renovations on their home. Do you think this is leading to an increase in borrowings on Helocs over the last 12 months?
Well, it certainly appears that consumers have leaned on their Helocs a bit more over the course of the past 12 months than maybe they had over the previous 2 or 3 years. We found in the surveys that we've been doing on COVID that a large number of consumers have been impacted, either in terms of less working hours or their income has been cut or impacted in other ways. And consumers have told us that they have borrowed more. I think that the message from FCAC is that this is a period in time when it's very important for consumers to be cautious with the Heloc in particular. As you mentioned, we've experienced a quite unanticipated run-up in house prices. And it's important for consumers not to overborrow or over leverage against that home, because house prices can fall, they can stabilize and slump in specific markets across the country. And it's a risk that consumers need to be aware of. They should have a plan for paying back their Heloc with their income. They shouldn't be depending on house prices to continue to do what they've done over the last year indefinitely. I think in addition, consumers also need to be aware that interest rates could begin to steadily increase. And while they may be able to handle the interest payments now with their income at the present time, they need to have room and comfort that they can handle a higher cost of borrowing in the future. And even if interest rates only go up 0.5% or 0.25% at a time, as you mentioned, the average balance is nearly $100,000, and that can lead to hundreds of more dollars of interest payments every month.
Right. And that's something that excites me about it too, because we know we have extremely low interest rates right now, but we are starting to see inflationary pressures in the economy. And inflationary pressures, whether they're south of the border or in Canada, are ultimately going to start probably driving interest rates up a little bit. I don't think a lot, but I think they're going to start creeping up. And I think that is something that the stress testing that's done when they borrow, but I tell people about working on their home budgets to stress test them all the time to try to account for that you're not living so close to the line that $100 or $200 can have a significant effect on borrowing. One of the other things that maybe we should cover is, how do people access the Financial Consumer Agency of Canada's resources so that they could go and read some of those reports? Because we actually, in what I do, we actually have a financial literacy booklet we give to people, and we actually reference your website as a place to go to find data. So maybe you can explain to the viewers where they can go to find that information.
Sure, thank you. Yeah, so all of our material is available at canada.ca/money. And consumers they'll find, as I mentioned, a wealth of material about Helocs, but also other important tools that they can use to create a budget and to really create a solid plan for the future, for retirement, and for if they decide to using a Heloc in a responsible and effective way.
Yeah, I think that's, I would encourage everyone to go to that site. As I say, we actually reference it in our discussions on budgeting with people because of your budgeting material, use of credit cards, how to apply for credit cards, benefits. I think there's just a wealth of knowledge on that site for people. Any final thoughts that we should leave with the viewers about Helocs, and the risk and the benefits of them? Because if they're used wisely, they can be a great way of, say, consolidating higher interest rate credit card debt into a lower payment, as long as you had a plan. But any final thoughts from yourself?
Sure, thank you. Now, I would encourage consumers to visit the Financial Consumer Agency of Canada's website at canada.ca/money, and I would encourage consumers to do research, to look into the information that we've made available, to shop around for their financial products and services the same way they might shop around for a car or a house that suits their needs, and to get themselves informed and to not hesitate to ask questions of FCAC, but also to ask questions of their lenders or of their banks. If there's something they don't understand, they should seek clarity on those issues.
Well, thank you very much for joining us today. It's been very informative. And again, I reference the Financial Consumer Agency of Canada as a great source of information to the viewers, and they should go on there and check out all those resources. Thank the viewers for joining us. If you have any questions or concerns about today's show, if there's any topics you'd like to see us cover, you can go to the show page at Rogers TV and send us an email. Again, thanks very much for joining us. Until next time, goodbye.